Hello, dear traders. This is Alex Gerchik, and today basically we're going to have a short webinar right before the new year about stop loss, what the stop loss, how would it help you, and everything else. I will begin again with my short presentation of me being in the business for so many years. As I said before, I've been in trading from 1996, and I told you the truth, if I wouldn't use the stop losses, I probably would be out of the industry already for a very long time. The stop loss, basically, it's your security, which will allow you to make sure you'll be fine and you'll be trade for a long time. But the most important thing, you're going to be alive. I remember when I basically started to be in the business in 1996, and in 1999 when I trade with a company named WorldCo. At that time, it was one of the biggest day trading firm with over 1,000 traders. I figured out one thing: that's all of the people who got burnt out in the industry and all of the traders who lost money. There was the traders who did not use the stop loss. The stop loss basically is your protection. And what we had before, when I worked for the corporation, we had risk management. It was automatic software which was not allowed us to basically make money, or lose more than we supposed to. I want to talk about today about the stop loss and what should you do with that. Most important thing, the stop loss is the part of the ATR. ATR is the average true range, and this is the average moves of every single stock. Every single stock is a totally different ATR. Some of the stock has an ATR of 50 cents, some of the stock has an ATR of $1, and some of the stock has an ATR of $1.50. So I want you to understand one thing, that even if you're trying to use the same stops for every single stock, that's not right. The very important thing, you have to take the ATR, and based on the ATR, use everything. What does it mean? For example, if the ATR of the single stock is the $1, your stop cannot be, let's say, more than 10 to 15 cents. Because if the ATR is going to be 30 or 40 cents, then a part of the ATR is not going to allow you to make a trade. So what does it mean? Your average ATR is supposed to be at least between 5 to 7 stops. So if your stop is at 10 cents, the ATR of the instrument, it's got to be between 70 to 80 cents. So when you trade, you have to make sure that your stop is the stop loss, is the part of the ATR. There is two different stops. There is one stop which is called mathematical stop, and there is stops which is called technical stops. We're going to talk about both of them. First of all, I want you to clearly understand, if you don't use the stops, 95% of the time you're going to be out of the industry very fast. Those people who is not using the stops, stop losses, they're out very fast for one simple reason. If you should understand one thing. For example, today everything is fine with S&P. You sit in with S&P, everything is fine. S&P is going up, everything is fine. But tomorrow is the bad news are coming out. The economy is bad. Non-farm payrolls are bad. Interest rate is going up, and you don't know what to do. And if you don't have a stop loss and S&P is dropping, I saw it with my own eyes, let's say 10 to 12%. And if you use the leverage, you can basically be down 30 to 40%. So if you don't have a stop loss, the losses can be very sustainable and extremely large. So just for you to understand, the stop losses is the must. I don't want to even talk about it any longer, but I want to tell you one thing. The stop losses is the must. Without the stop loss, you can't trade. Sooner or later, you're just going to lose it all at one point, and you're not going to be able to do anything if you're not using the stop loss. A lot of time, the people basically not putting the stop losses, making sure it's okay. I have it right here. I have it right here in the paper. I have it somewhere else. No way. No way. You shouldn't do that. The stop loss has got to be clearly in the system. And if you have a system, you have to put it there and forget about it. So, if you put a stop loss, you have to make sure that you're not going to move the stop, you're not going to take the stop out, you're not going to put the new stop. If you have a stop, you have to make sure that nothing is going to be, and the stop is not going to be moved. As I said before, you have two different kinds of stop losses. The first of them is a technical stop loss, where you only use the chart, and another one is the mathematical stop losses. And as I said before, the mathematical stop loss is supposed to be based on the ATR. If the ATR, as I said, $1, the stop loss shouldn't be more than 10 to 15 cents. The ATR should be divided into probably 5 or 6 stop losses. If the ATR is big, let's say 2 or 3%, you take 1/10 of the ATR, and this is your stop loss. Now I want to show you a few. I want to show you a few stocks, which is you can see very good technical stop loss. Take a look at this. For example, this is just a company. It's called FCEL, just a regular stock, and there's two different ways to put a stop on this stock. First of all, you can put a stop basically, let's say in ATR, you take the average ATR. ATR is the high minus low. So let's say you take it the high minus low, it's 209 to 195. It's a 14 cents is the ATR, which is about 7%. It's pretty high ATR. So you can take 14 cents, split it, let's say into, let's say at least 5, and you have a stop of 3 cents per share in this particular stock. Or you can basically go with a different way. Take a look. If you're going to take a look, I want to show you something. If you take a look at the low of the stock, take a look. The low is 185, low is 185, and low is 185. When you know there is a limit buyer or limit seller in the stock, you can put a stop right there. It's going to be a technical stop. So for example, if you put a stop just based on the chart, then your stop is called technical stop. For example, if you have a stop right here, you know one thing for a fact, after breakout of 231, you have a large move, then you put in a stop above 231, it's going to be a protective stop or a stop to the entrance. But you have to make sure your stop is going to be in a technical way or the part of the ATR. If this is a technical stop, take a look right here. It's the $1.85, $1.85, $1.85. This is a very clear limit player. So in this particular case, you can put a stop right here under $1.85, and you don't have to put a big stop in that instrument. Take a look at the stock DPRX. Very good scenario I want to show you so you'll understand. This is right here as well. You can put a very good technical stop. Take a look at this. The low is a 125. Low 125, low 125, low 125. You see, so you have a very big limit buyer right here who is not allowed in the stock to go any lower than the 125. So in this particular case, you can put a stop right here, right below 125. So you're saying to yourself, if 125 it's going to be broken, then I'm definitely going to be get out. A lot of times traders asking the questions, what is the positive or negative stories about the stop loss? There is nothing negative about the stop. If you use the stop, you're definitely going to be protected. Now the people asking the second question, what is the difference between stop loss, between technical stop loss and mathematical stop loss? For example, the ATR for this particular stock, we can calculate, let's say 125, let's say to 140. It's pretty big ATR for this stock. Is about 16 cents. It's about almost 10%. So the ATR of the average through range, average move for this particular stock is about 10%. So in this case, you can definitely put stop loss of let's say 3 or 4 cents, and it would be fine. But in this particular case, if you're going to take a look at the stock, you can really put a stop of less than the 2 cents. For example, this is 125, you can put 123 because this is a limit buyer. If the limit buyer is getting broke, then definitely you can lose much more money than a stop loss. So in this particular case, you don't have to worry about, and you can put a stop loss below 125. As I said, take a look. That's a very big limit buyer. 125, 125, 125, 125, and 125. So you can basically put a stop right there below, and you're not going to have any single issues with that. As I said before, there's two different stops. There's a technical stop where you basically using the chart and you put in the stop below certain levels or above certain levels. And there is mathematical stops where you basically put in the stop based on the ATR. We'll take, for example, the company, we'll take the stock Apple, and we'll go, let's say, high minus low, 115 to 113.75. You have $1.50. It's an average ATR, so $1.50 average ATR. You can easily put a stop at 15 cents, which is going to be fine. My advice to you, don't put it too big of a stop losses, because if the ATR is going to be small and the stop losses is going to be big, then you have no chance to make money. Because if, for example, your stop loss is 20 cents, your take is 60 cents, and the average through range for the stock is 50 cents, your chance to make money on it, it's basically almost equal to zero. And as I said before, in any single stock that I can take, you definitely know one thing for a fact: you have to have a protective stops. For example, take a look. The stock is called CALA. That's the real chart. It's for today, and you have a very important level of 385. Take a look. We went below 385 and went straight lower. For example, 385, it's a critical level for the stock. For example, if the stock is breaking 385, it must go lower, because all of the people who bought the stock above 385, right here, there was a long buyers. And then the very important thing, these buyers are going to be trying to get out, they're going to initiate the first move. So once basically anything below 385, the stock is going to go much lower. So if it's going to go below 350, it's going to go even lower to $3 a share. So your job is make sure where you're going to put a stop, and you're not going to move any single stop. I'm going to show you a few different examples. It does not really matter what you trade. For example, take a look. This is a very good example as well. $4 a share. This is a limit buyer. Take a look. I want to show it to you. See, $4, $4. Take a look. $4 and $4. So there is a very big limit buyer sitting at $4 a share. Take a look. If you put a stop in the wrong place, you're still going to get destroyed. You're still going to lose. But you have to make sure that your stop is going to be the same position. So for example, if you put it right here, if you have a level of $4 a share, even if you put a stop right here, most of the time the stop is going to get destroyed. So your job is to put a stop in the right place. In this particular case scenario, of course, it's obviously much easier to use stops on a technical level, not on a calculation, not in a mathematical. Because if you basically don't have a level and you don't know where to put a stop, you're definitely going to lose money, and your stop order, mathematical stop order, will not allow you to do anything. As I said before I continue with the Happy New Year wishes, I want to tell you one thing. There's two different stop, and you cannot trade without the stop loss. The only stop loss, only situation where you don't have to put a stop loss is the situation where you're trading a lot of stocks together and you have an equally weighted portfolio. Only in that case you don't have to put a stop loss. But most of the time, I tell you the truth about myself. I always put a stop loss. That's what I've been in the industry for 20 years. No matter what's going on around, I always have a stop loss in any single case scenario. I remember the story in 2006. Once I had no stop loss, and it cost me almost $14,000. But the most important thing is not how much it's going to cost. It's not about the dollar, how much money you're going to lose. The most important thing, it's what's going to happen to you once you're going to oversee the stop losses. So to finalize everything, the stop losses is the must. You have to put a stop losses. Second very important thing, either you put a stop losses mathematical, which is the part of the ATR, average through range. For example, it's you'll take 1/5 or 1/7 of the, or 1/10 of the ATR if the channel is big. And a very important thing, it's if you use technical stops, all technical stops have to go right, either behind or above the levels, nowhere else. For example, I will show you just a little scenario. A lot of times people put in a stop in the bar, inside the bar, and it wouldn't do anything because you're going to eat the bad volatility. ATR, that's the volatility. Anywhere you're going to put the stop in between, you're going to eat a bad volatility. Anyway, this is our last webinar in English before the new year. I'm wishing everyone a happy holiday. All the best to you guys. And it's been a president of the company Gerchik Co. And have yourself a nice day. Thank you.